recurring theme of our introduction to financial literacy has been the need for businesses to raise money. So the questions for us now are, how precisely does that occur? We've seen before that banks are one source of financing, but what's another good source?
An ATM?
No, not an ATM. Where do you get your food?
At a stock exchange?
No, this is just an analogy.
Well, I get my coffee at an artisanal roasting house / cupping laboratory. I get my cheese at a family-owned organic dairy about 30 miles away.
And you go to a cobbler for your new shoes. You live in a medieval fairy tale? No, seriously, where do you usually go?
Walmart.
Of course you do. Most people get their groceries at a supermarket.
Wait, is this being taped? I meant Whole Foods.
Okay, well, why do you go to a supermarket to get your groceries? Why don't you go to a butcher to get your meat? Why don't you go to a baker to get your bread separately? Why don't you go to a costermonger to get your fruit and veg?
Because I've never heard of a costermonger.
Any other reasons?
Because shopping is already a chore, and making 10 different stops sounds like a drag.
Yes, it's certainly more convenient to go to one central market than to go to separate purveyors for each of the different things you need. And we're going to see that there are economic benefits and economic costs to that kind of convenience. Stock exchanges are also called stock markets. Do you know any?
The exchange for stock in Wall Street?
Yes, that's the New York Stock Exchange, and it's one of the biggest in the world.
Well then, there's the Boston Stock Exchange, the Chicago Stock Exchange, the Philadelphia Stock Exchange. I could go on and on.
No need, but you're right. Most major cities in the United States have or once had a stock exchange, although these days most of them have been acquired by larger stock exchanges. Let me ask you though, what about the NASDAQ?
Love his music. Totally got his back versus Jay-Z.
No, it's another stock exchange.
Oh yeah, I've been there. National Association of Daiquiris.
Right. The National Association of Securities Dealers Automated Quotations. But you haven't been there. It doesn't exist in person. It's an electronic exchange. Let's take a look at the major players in all stock markets.
Well, there's Gordon Gekko, obviously. And I've heard of that French guy, Warren Buffett.
I meant more generally. Let's take a look at the two primary players in any commercial exchange, not just a stock exchange.
Well, naturally, there's the person buying the stuff and the person selling said stuff.
Absolutely correct. Since a stock market is just a subspecies of any market, we need buyers and we need sellers. So, on a stock market, what's being bought and sold?
At a stock market?
Yes.
Stock?
Sometimes, yes. And sometimes also bonds. That is, stock exchanges are the places to buy both debt and equity, the two primary ways of bringing external financing into a business. So now my question is, who's doing all this buying and selling?
Businesses?
Yes, companies that wish to raise money will sell debt, that is bonds, or they'll sell equities, stocks. Who's doing the buying?
Businesses?
Yes, but we typically think of the buyers as investors. That is, anyone who wants to make some money from the money they already have. And investors can be both other businesses or business entities, or they can be humans, like you and me. So if a company like Google wanted to raise some money to expand its business, it could go to a stock exchange, as it already does, the NASDAQ, and it could sell its equities or it could sell its debt to investors like large institutional buyers or people like you and me, and we could put our money in there if we thought it was a good investment. But who are we leaving out of this relationship? Who else do you need to help with a buying and a selling transaction?
Sales clerk?
Sort of. A broker or a dealer. That is somebody who specializes in making matches between people who want to buy and people who want to sell.
Very friendly of them.
They get a fee for that.
Oh.
So the cost of buying and selling investments on a stock exchange also has to include the cost of brokerage fees, which you pay both when you buy and when you sell. That means it can create quite a drag on your investments. It's a very important cost to bear in mind when you're trading stocks on stock exchanges. But what determines the price of the investment itself?
Whatever the company wants to charge.
At the beginning, perhaps. But after the first sale of securities from a company to investors, most of the subsequent transactions are between the investors themselves. It's a little bit like car sales. The very first sale of a car is from the manufacturer to the first buyer, but there's plenty of car sales that involve subsequent car owners to other second-hand car owners.
So the price is whatever the blue book says, or whatever a fool will pay.
Yes, sort of. Stocks and bonds have both an intrinsic value, which turns on how well the company is doing, but they also have a trading value, which turns on how much people are willing to buy or sell them for.
Those aren't the same thing?
No, they're not. What's the intrinsic, what's the fundamental value of your clever, ironic, and vintage t-shirts?
$50 to $100.
Doubtful. It's probably just a few cents worth of cotton and ink. The rest of the price that might go into a t-shirt like that is more about trendiness, momentum, irrationality, and any of the other things that might influence what somebody is willing to buy it for from you.
I'm with you with your pricing theory of efficient markets combined with the noisy signal of momentum trading, but just a note, nothing called trendy has ever actually been trendy.
So what are the benefits of a stock exchange for the investors?
They don't have to go to the costermonger.
Right, the convenience of being able to buy lots of different investments in one place. And all that competition of having lots of different investments available should help produce better prices, that is, better returns on your investments, and perhaps also better information, more transparent information about each of the companies that's selling its investments. In addition to tracking the particular price of any given security, we can track the general performance of a stock exchange by using an average. The most famous averages are stock indices, the S&P 500, which tracks 500 different companies, or of course the Dow Jones Industrial Average, which tracks 40 different issuers. The general performance of those companies tells us generally how the stock market is doing.
So what are the benefits for the issuers?
Lots of investors is also a good thing for companies, because lots of investors means that there's a lot of money out there to be brought into the company. We call it liquidity. And the greater the liquidity is, generally the cheaper it is to bring investments into your company. The less you have to pay on your debt, and the lower returns you need to pay on your equity. Regulation, of course, is an additional cost on businesses since they have to comply with those rules. But some people believe that additional regulation makes investors feel more comfortable and therefore brings more investors and increases liquidity in stock markets.
How so?
Consider the difference between riding a roller coaster in, let's say, the glorious nation of Kazakhstan compared to riding one in the United States.
Depends what I wanted out of it.
A modest degree of entertainment with your life intact at the end.
What are my choices again?
Many people will choose the ride in the United States because of the better regulatory system here and the more aggressive policing of that regulatory system. Of course, those additional rules and those additional policing of the rules is going to come with a cost, so my guess is that riding a roller coaster in the United States is also going to be more expensive.
But much more exciting in Central Asia.